Patricia got the call on a Tuesday morning in March. She was sitting at her kitchen table in Conyers, Georgia, drinking her second cup of coffee, and her financial advisor was on the other end of the line telling her the same thing he had been telling her for 3 years. Wait. Keep the money in the IRA. Let it grow. Don't touch it yet. She had worked 31 years as a postal carrier, walked those routes in the Georgia heat, and she had done everything right. She saved, she contributed, she waited. And her advisor, a man she trusted completely, kept telling her that waiting was the smart play. Patricia turned 72 last October. She is now 11 months away from a deadline that her advisor never mentioned. A window that opened quietly at the beginning of 2026 and will close permanently on December 31st of this year. A window that has never existed before in the entire history of the tax code, and once it closes, it is gone. Not until next year. Not until the rules change again. Gone. If Patricia does nothing, the IRS is going to take an extra $11,000 from her retirement savings that she did not have to give them. Not because she broke any rules, because nobody told her the rules had changed. Right now, in this moment, there is still time. But not much. What I am about to show you is the reason I made this video today, and not 6 months from now. Patricia is not a cautionary tale about bad decisions. She made good decisions. She saved aggressively. She contributed to her thrift savings plan every single year. She has a modest pension from the Postal Service. She took Social Security at 67, and her IRA has grown to just over $400,000. By every standard measure, Patricia did everything her advisor told her to do. The problem is that her advisor was giving her advice based on rules that no longer apply in 2026. The advisor missed it. Her tax preparer missed it. The woman at the bank who helped her set up her accounts definitely missed it. This is not about blame. This is about a specific tax law change that took effect in 2026 that most financial professionals have not fully absorbed yet, combined with a deadline that is sitting at the end of this calendar year. And if you are between the ages of 65 and 73, or if you have a spouse in that range, what I am about to show you could be the most financially significant thing you watch all year. Today I am going to show you everything you need to know before that window closes on you. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. Every person's numbers are different, and the strategy I am describing needs to be run against your actual tax return before you act on it. My name is Kevin Retires. Every week I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. We cover the stuff that the big financial media outlets skip because it is too specific, too wonky, or not dramatic enough for a headline. But for retirees, this specific and wonky stuff is worth thousands of dollars a year. Here is exactly what you are going to learn in the next few minutes. You are going to learn what the 2026 tax window actually is, why it exists specifically this year and will never exist again in this form, and how a provision in the One Big Beautiful Bill, the senior bonus deduction of $6,000 per qualifying person, stacks on top of already locked-in tax brackets to create a withdrawal opportunity that is genuinely unprecedented. Then I am going to show you the real numbers for a married couple, Patricia and her husband Robert, walking you through the exact dollar amounts at stake. And then I am going to cover the 3 costly mistakes that retirees make right now, in the months before they turn 73, that permanently close this window before they ever use it. One of those mistakes is something nearly every retiree with a financial advisor is doing at this exact moment without knowing the cost. Let's get into it. To understand the window, you need to understand what changed and what is about to change. For most of the last decade, the conventional wisdom was simple. Keep your money in the IRA as long as possible. Let it grow tax-deferred. When you are forced to take required minimum distributions, which the IRS requires starting at age 73, you pay the tax then. That advice was not wrong under the old rules. Under the rules that exist right now in 2026, it can cost you a catastrophic amount of money. Here is what changed. The One Big Beautiful Bill, signed into law and effective for the 2026 tax year, includes a senior bonus deduction of $6,000 per qualifying individual for taxpayers who are 65 or older. If you are married and both spouses are 65 or older, that is $12,000 of additional deduction sitting on top of your standard deduction. For a married couple filing jointly in 2026, the standard deduction is already $29,900. Add the 2 senior bonus deductions, and you are looking at $41,900 of income you can receive completely tax-free before the IRS collects a single dollar. Let that sit for a second. $41,900, tax-free. Now here is where the window opens. The 2017 Tax Cuts and Jobs Act locked in reduced marginal tax rates that are currently scheduled to expire after December 31st, 2025. But legislative action in 2025 extended, and in some cases made permanent, several of those bracket structures for 2026. The 12% bracket for a married couple filing jointly now runs from approximately $23,200 all the way up to $94,300 of taxable income. The 22% bracket runs from $94,300 up to $201,050. This is the combination that creates the window. A large tax-free floor from the stacked deductions, sitting underneath an unusually wide 12% bracket, sitting underneath a 22% bracket that does not kick in until you are well past 6 figures of taxable income. The window is the gap between what you owe at those rates right now and what you will owe when your required minimum distributions kick in at 73 and push your income into higher brackets automatically, whether you planned for it or not. Let me show you exactly what this means for Patricia and her husband Robert. Robert is 68. He was an electrician. He has a traditional IRA worth $320,000. Patricia has her $400,000 IRA. Combined, they have $720,000 sitting in traditional pre-tax retirement accounts. Their income right now, before any IRA withdrawals, looks like this. Patricia's postal pension brings in $19,200 a year. Her Social Security is $14,400 a year. Robert's Social Security is $18,000 a year. Combined pre-withdrawal income, $51,600. Here is the problem hiding in those numbers. When Patricia turns 73 in 2027, the IRS is going to require her to take an RMD on a $400,000 account, or more depending on growth, using the Uniform Lifetime Table. At 73, the distribution period is 26.5 years. 400,000 divided by 26.5 is $15,094. That is just Patricia's RMD. Robert hits his RMD at 73 as well, which at that point could push $320,000, creating an additional forced withdrawal of roughly $12,000 on top of everything else. Now their taxable income has jumped by $27,000 with zero planning and zero choice. But right now, in 2026, before either of them has triggered RMDs, they have control. And that control is worth real money. Here is the math. With their $41,900 deduction stack and their $51,600 of base income, their taxable income before any IRA withdrawals is approximately $9,700. They are barely inside the 12% bracket. They have room, $84,600 of room, before they even touch the 22% bracket. If they pull $80,000 out of their IRAs this year, strategically and intentionally, they pay tax on roughly $70,300 of it at 12%, because the first $9,700 was already covered. That is $8,436 in federal tax on $80,000 of withdrawals, an effective rate of about 10.5%. If they do nothing and wait for RMDs to force the issue, that same $80,000 of income, now mandatory, not optional, arrives in a year when Social Security taxation has increased, IRMAA surcharges on Medicare may have kicked in, and the bracket structure may look very different. The difference in tax on those same dollars, withdrawn in a worse year under worse conditions, can easily reach $11,000 or more when you factor in the IRMAA impact alone. The lowest IRMAA surcharge tier for 2026 adds $2,990 per person per year to Medicare Part B and Part D costs combined. For a couple, that is nearly $6,000 a year in additional Medicare premiums, triggered by income crossing the first IRMAA threshold, which sits at $206,000 for married filing jointly. One bad year of planning can push you over that line, and once you are over, you pay the surcharge for the entire following year. That is not a hypothetical. That is math that Patricia's advisor never ran for her. And now here is the part that almost nobody tells you. There are 3 specific mistakes that are closing this window for retirees right now, even the ones who know the window exists. The first mistake is waiting for the advisor to bring it up. Most financial advisors are not tax planners. They manage portfolios, they allocate assets, they rebalance. Running a multi-year Roth conversion ladder analysis or a strategic pre-RMD drawdown plan is not in the scope of what a standard AUM-based advisor does, unless you specifically ask for it. Patricia never asked, her advisor never offered, and the year-end deadline does not care about the reason. The second mistake is treating all three account types as interchangeable. Retirees who have money in a traditional IRA, a Roth IRA, and a taxable brokerage account, and many do, often withdraw from whichever account feels most accessible. That is the wrong order. The right order depends entirely on your current tax situation, your future RMD projections, and the specific brackets I just walked you through. Pulling from a Roth when your traditional IRA is sitting there accumulating a future RMD liability is like paying full price for something that was on sale. You are spending after-tax dollars to protect pre-tax dollars that are going to get taxed at a higher rate later. For a couple in Patricia and Robert's situation, pulling from the wrong account first can cost between $4,000 and $9,000 in unnecessary tax over a 5-year window, based on the bracket differentials I described. The third mistake, and this one is the one that costs the most and is the hardest to reverse, is doing a large Roth conversion in the same year as a large traditional withdrawal, without modeling both on the same return. Retirees who hear about the Roth conversion opportunity and the traditional pre-RMD drawdown opportunity sometimes try to do both aggressively in 1 year. The combined income from a big Roth conversion plus a big traditional withdrawal can push a couple from the 12% bracket into the 22% bracket and simultaneously trigger the first IRMAA tier. That single misstep can add $7,000 to $13,000 in combined tax and Medicare surcharges in 1 year. The window is real, but it has to be used precisely. So here is what you do with what you just learned. If you are between 65 and 72 right now, you are in the prime window. This is your year to sit down with a CPA who specializes in retirement tax planning, not your investment advisor, a CPA, and run your 2026 tax projection before October. You need time to make withdrawals or conversions before December 31st. Model your base income, stack your deductions, find your bracket ceiling, and pull from your traditional IRA up to the top of the 12% bracket. For most couples in a situation similar to Patricia and Robert, that means pulling somewhere between $40,000 and $80,000 this year, paying somewhere between 8 and 12% effective federal tax, and permanently reducing the IRA balance that will generate forced RMDs in a few years. If you are 68 to 72, this is not a nice-to-have conversation. It is a deadline. Every year you skip this analysis, the IRA grows, the future RMD grows, and the tax cost grows with it. Patricia can still act. She has until December 31st, 2026. After that, the senior bonus deduction may look different. The brackets will certainly look different, and the exact combination of conditions that makes this moment so powerful will not exist again in the same form. If you are already 73 or older and your RMDs have started, there is still a version of this strategy available to you, specifically around qualified charitable distributions, which allow you to send up to $105,000 per person directly from your IRA to a qualifying charity, satisfying your RMD without the money ever appearing as taxable income on your return. That is a strategy worth knowing regardless of where you fall in the age range, and I have a dedicated video walking through exactly how it works that you should watch after this one. The action here is not complicated. Pull out your most recent tax return. Write down your total income number from line 11. Subtract your standard deduction and the senior bonus deductions you qualify for. What is left is your current taxable income. Now subtract that number from $94,300. The gap is your available space inside the 12% bracket. That space is the window, and you have until the last day of 2026 to use it. Patricia does not have to lose that $11,000. Neither do you. But the calendar is already moving. If this video helped you see something you could not see before, the subscribe button is right below this video. That is the only ask I ever make.